2022 has been an extraordinary year in the fixed income markets. We've seen the lingering and uneven global recovery from the COVID pandemic. We saw a rapid pivot by the US Federal Reserve to address stickier and higher than expected inflation. And we are witnessing large-scale conflict in Europe, which has exacerbated an energy crisis. The prior 2 decades were characterized by historically low inflation and a highly accommodative monetary policy, allowing for a depressed global interest rate environment. That era has drawn to a close, and we may now be in the midst of a regime change, faced with an era marked by persistent structural inflation, hawkish central banks, and heightened geopolitical risks. Many of the catalysts for the current macro and market volatility are likely to remain in place for the near and intermediate term, so allocators should not expect them to immediately resolve or mean revert. This is likely to mean several things for fixed income investors going forward: continued volatility in capital markets and less certainty of central bank intervention during periods of economic or market turmoil. While we know that central banks will, at times, need to act to preserve financial stability, their threshold for taking such actions will likely be much higher than prior cycles. Expect more dispersion among countries that pursue different combination of fiscal and monetary policy, between fixed income sectors, which will respond differently to changing macro and fundamental conditions, and between individual issuers, as the market becomes better at distinguishing between them and how well or poorly they will fare in the current cycle. There will be added value in taking advantage of sector dislocations and asset pricing during this turbulent period. In short, active management can potentially thrive in an era like this, particularly one where we expect a combination of less market liquidity and reduced financial reserves to no longer float all boats as it has in the past. On a positive note, asset valuations have become more attractive across most fixed income sectors. While this is reflective of increased risk premia, as well as expectations around central bank actions, we also think the fixed income complex is now beginning to offer valuations that are more in line with the world of elevated volatility. In our view, that makes fixed income a more attractive asset class to allocate capital to in 2023.